I'm Eddie Sunderji, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. So Jeff published his Sunday night weekly playbook, or his weekly playbook on Sunday night, which is available on Substack at hugeinsights.substack.com. Jeff, welcome.
Hey, how you doing, Mehdi?
So Jeff, before we dive in, I just want to urge our viewers, if you haven't yet, make sure you like and subscribe to Your Finance TV to stay on top of our content. Just had to get that little plug in there. But Jeff, over to you. Let's kick off with the top down.
Yeah, as you know, Mehdi, last week was a pretty profound move in the markets for a lot of people. I mean, S&P was up, I think, 5.85%. Not bad, right? Coming off, a fairly difficult period, a near 11% decline in the S&P off of the intraday high back in July. And, certainly has a lot of people wondering whether the bear market is over, right? Or the correction is over. We have a little bit different take on it, as I think you know. And this week there's quite a bit to be concerned about. I mean, I think we have 8 Fed speeches this week. Last week we had Powell basically coming out and speaking quite dovish. He changed his tone quite a bit. Continues to say the same things, but very little emphasis on concerns about inflation, more emphasis on the progress that's been made. And so, I was a little surprised by that, to be perfectly honest with you, because the progress hasn't been, steady the last several reports. I mean, it's kind of been stalling out. And so, I think the Fed's been on pause. I think that they're going to remain on pause for the rest of the year. We may see them come in the first quarter with one more cut. It's debatable. I think the odds are kind of like 80-20 against it right now. So, I don't think we can really focus too much on that. But, we're going to learn a lot more from these 8 speeches this week, beginning today. And I think, the Fed is going to punctuate the points that they really want to hone in on, right? Next week, we've got CPI and PPI. The jobs report came in a little bit weaker than expected, with unemployment ticking up. That was another area that was kind of putting a feather in the Fed's cap at this point. They're starting to see the results. Earnings are really winding down right now. And so I don't know that we're going to see a lot of earth-shattering news from that. We did hear from the Magnificent Seven in force over the prior 2 weeks. Apple was kind of the last of those 7 to report. I would say that their report was received with a thud, even though the market was up as strong as it was. They reported their 4th consecutive quarter of year-over-year revenue decline. Certainly nothing to get excited about at Apple, despite the fact that, it is one of the largest market cap companies in the world. We'll talk about that a little bit more in the segment. And then, I think at the end of the day, I think there's a lot of people talking about the expansion of breadth. We saw a big move in the Russell 2000 off the lows. Russell 2000, by the way, was down 33% from its prior all-time high as of a week ago Friday. And, bouncing off of that, there's a lot of work to be done for the Russell to recover. So I'm not too optimistic that we're in a new bull market for the Russell just yet. But we continue to be cautious. We think the S&P 500 has some very interesting sort of characteristics to it right now. And we think there's some very interesting cycle pressures that continue to weigh on the S&P 500 into at least the end of November. And so we'll detail some of that as well. But the advice we continue to give our clients at this point is remain patient, minimize net equity exposure, and maximize cash reserves at this point. And we'll revisit that advice at the end of November. If I could just add one thing, we did just publish our latest newsletter on Saturday, November 4th, entitled The Economic Dial of Destiny. I think it's worth your time to read it. And it's very fresh off the press with, I think the content in there's got a long shelf life. So I would give it a read if you've got a chance.
Great. Thank you very much for that, Jeff. So you touched on it in your opening statement, but there has been a big focus on breadth, especially this topic has been in the rally consistently on and off. So can you break down some of the breadth thrust advocates on I don't know if I call it X, Twitter, whatever it is, because I know you touched on this in your note as well. So yeah, run us through some of these.
First of all, let me say that the people that I highlight in my note are the people that I have the utmost respect for, and I wouldn't put them in my note if I didn't. At the end of the day, these are real pros, really talented, bright people with decades of experience. 100 years among the four of them that I highlight, and I'm not going to use any names, but at the end of the day, these guys are real advocates of the breadth thrust. And what is a breadth thrust? Well, it's a significant broadening of market participation over a short period of time, usually 5 to 10 days. It's calculated this way. There's the Marty Zweig kind of popularized this measure back in the 1980s. The Zweig breadth thrust looks at advancing issues divided by advancers plus decliners. It takes the 10-day moving average of that. And when it moves from below 40% to above 61.5%, that marks what Marty called a breadth thrust. So, what do we have to say about it? Well, we got one, right? Okay. It doesn't have a perfect track record. In fact, not only does it not have a perfect track record, it oftentimes misses. It doesn't, there was a period, I think, from like 1994 to 2008, where we didn't get a breadth thrust, yet it was one of the best, periods of time for equity, certainly on the front end of that, through around 2000. And then from about, 2002 to 2007, another, pretty strong rally, consistent, durable rally took place over 5 years, and no breadth thrust. So it's not something that I think we can rely upon. The other thing is the real vocal advocates of this are focusing on a specific period of data from 1950 to present. I don't know why they chose that period, because the S&P 500, as we know it today, actually came into being in 1957. So there's no excuse for not going back all the way to, say, 1928, where S&P, actually had the S&P industrials, right? We can combine that data feed like most services do and produce S&P price data from 1928 to present. But, for whatever reason, most people elect to choose from 1950 to present. And in that period, it's got a fairly decent track record. However, if you go before 1950, it's not so good. In fact, I think 14 of 18 breadth thrusts that occurred before 1950 failed. And so it's kind of convenient to leave that out of your statistics. And, that's one of the problems we have with the basic calculation of the breadth thrust.
So, Jeff, can you break down the Whaley breadth thrust and what that all means? Because I know you wrote about this in your note as well.
Yeah, there's an analyst by the name of Whaley. He's an extremely bright guy. Published a paper, I think back around 2009 or so, that really studied all the various measures of breadth. And his conclusions were that, well, if we used a series of different breadth measures or breadth thrust measures, we'd get better results. But actually testing all the periods from 1 to 20 days, he determined that a 5-day moving average period produced the best results on a 3, 6, and 12-month combined basis. And so, he gets a lot of credibility, and well-deserved for the work that he did with respect to, punctuating the importance of breadth thrusts, right? This big expansion in the participation. That being said, he tweeted last Friday, or maybe it was Saturday, regarding last week's price performance that, let me see if I can get this right. I think he said last week's 5.8% advance came without a 2% up day. And he said that he's seen 16 of those since 1950. And based on that, the forward results were of the pedestrian variety. So, I don't think he was very impressed with it. And I did catch on Twitter, maybe it was yesterday or the day before. He made some additional comments on it, basically saying that it didn't really, didn't get him to raise his eyebrows too much. So for the guy who really is the, widely regarded expert on breadth to not be that impressed with last week's price action is really saying something.
Well, that ties us nicely into the next chart. Can you talk to us about the NYSE moving balance indicator?
Yes. So, this is a really esoteric, little known measure of breadth, or breadth indicator, breadth thrust indicator, if you will. The moving balance indicator is developed by a guy named Humphrey Lloyd back in the 1960s. Lloyd was a trader, technician, professorial sort of a guy. He wrote a book on it called Moving Balance Systems in 1976 that detailed how he calculated this. It's a very complicated calculation. Takes into account not just net advancing issues, but also volume adjustments for that, and also, requires follow through. So, for example, Friday's print required Monday's open in order to calculate it. And so we had to actually wait to get the chart until Monday. And so you've got an updated version of that chart in your possession right now that shows the actual reading, which is, more or less what we expected, what was necessary to initiate a breadth thrust by the moving balance indicator. Now, I learned about this from my days at the Leuthold Group. Steve Leuthold was a big advocate. He knew Humphrey Lloyd. They're of the kind of same ilk, same genre. And Steve, being the quant that he was, found this to be particularly interesting because since Lloyd introduced it in 1965, it had predicted, due to the signal that it generated, every durable bull market rally. And when I say durable, I mean that it rallied at least 20%, which is kind of the common man's definition of a bull market, before making a new low. Okay, so and there were no false positives. That's the other thing, and that is the big problem with the Zweig breadth thrust measure, is that it gives a lot of false positives. And so, the MBI has basically a 100% perfect track record. The problem is the signal is so rare, it's almost kind of like, wow, I haven't heard anybody talk about the moving balance indicator for 5 years. I think the last thrust it gave was in 2020, so it's about 3 years ago. But let me be honest, it's a very rare signal that's generated, but it's a very reliable signal. And so we put a little bit more emphasis on a signal generated by the MBI, and when we don't get one, we're a little bit more skeptical because of the false positives that are evident in the data series of the other measures. And so, that being said, we're still sitting on the sidelines waiting to see if the MBI gives us a signal. The signal would be a move above 85%. We're at 63% as of Friday's close. The thing that really suggests to me that we're not likely to get there anytime soon is the simple fact that as of Friday, the number of stocks in the S&P 500, they're trading above their 50-day moving average, barely got above 50%. I think it was 50.4%. Yesterday, that ticked down to 46.6%. So, we're not even above 50% as we open this morning. And so that leaves me a little skeptical about the whole notion of a breadth thrust having a lot of impact and carry through or follow through this time.
Fantastic. Thank you for that, Jeff. So, let's go back to the technicals that we always look at. If you wouldn't mind bringing us up to speed on your primary degree, Elliott Wave analysis, that would be really helpful.
Yeah, so 3 things. Number one, we changed the count, and that's not a bad thing or anything. We run rolling counts. We've got, a preferred, we've got alternate number 1, alternate number 2, alternate number 3. We don't know which one's right. It's the preferred. Our sense is that the odds favored the preferred count. With last week's price action, it was clear because the rally was too extreme, that our initial preferred count was probably not correct. So we actually moved down with alternate count number 2. Alternate count number 2 basically suggests that the entire decline from the July 27th intraday high to the October 27th intraday low was a leading diagonal 5-wave motive wave. So we count that as intermediate wave 1 down of primary wave 3 down. So the rally last week is part of or all of what will ultimately be intermediate wave 2 when it's complete, right? Intermediate wave 2 is likely to retrace a significant portion of intermediate wave 1 down. So what could that potentially be? Well, we suspect it's going to be toward the high end. So we're estimating a 61.8% retracement minimum. We've currently retraced about 50%. So we think there's a little more upside. The 61.8% retracement level comes in at S&P 4415. That also coincides with the 89-day moving average. And the reason that we're looking at the 89-day is because it's Fibonacci number. We look at all the Fibonacci-based moving averages. We don't put every single one of them on every single chart, but when we find one that is, that is tracking the current trend, and one of the things that caught our attention by the 89 is the 89-day moving average was where we saw the gap down in September. And so we think it's a high probability that will capture the upside as well, right around the 618 retracement. The other thing that's interesting about the 618 retracement is it comes into play with the, I think, October 17th high, which was the intermediate wave, or I'm sorry, minor wave 4 of intermediate wave 1 high. And so, what you'll often see is a retracement, say intermediate wave 2 would retrace to a fourth wave extreme of one lesser degree of trend, which would be at minor degrees. So that all kind of comes into the same sort of zone. So it seems like there's a very good probability that will hold the upside and contain it. It also kind of falls right into that gap resistance level. So all those things together kind of lead us to believe that 4415 is probably the upside extreme for an intermediate wave 2 counter trend advance. Now, once that advance peaks, and we think it will peak probably on or about November 13th. Why November 13th? It's a Montgomery cycle turn date, and the market has been in a perfect rhythm over the last 4 Montgomery cycle turn dates. They have marked a significant peak or trough, plus or minus 2 days over each of the 4 over the past 2 months. So we think it's a high probability that the November 13th date will also mark a good turning point. I'd also point out that the market bottomed in 2022 on October 13th. We saw the intermediate wave A extreme achieved on December 13th. And then we saw the intermediate wave B extreme achieved on March 13th of 2023. So the 13th of the month has been repeating as a key turn date, and we think this is very likely to be the case. Now, if we top on or about the 13th at about S&P 4415, what do we think is going to happen next? Well, we think the market's going to careen lower in a third of a third wave decline. This will be intermediate wave 3 of primary wave 3 down. And we think it should be a rapid and dynamic decline that carries prices at least back to the March lows around S&P 3800, but possibly much lower. And we think it will achieve its terminal point on or about November 27th, which is the final Montgomery cycle turn date of 2023. If we're right about that, if that plays out as expected, then we should expect a pretty aggressive year-end rally off those November 27th lows. How far it carries is anybody's guess, but I would expect it to be well below the intermediate wave 1 low of roughly S&P 4103. So we won't exceed that level if our analysis is correct.
That's quite the 2 week period, the 13th to 27th, that we're going to watch these turn dates. So, Jeff, our friends, the Magnificent Seven, how have they been doing lately?
Well, they're all doing very, very well as of last week. Prior to that, not so good. They all came into, obviously bear market extreme lows into Friday, October 27th. They bounced aggressively out of there. NVIDIA leading the pack, up double digits. All except, I believe, Apple outperformed the S&P 500. And, again, Apple was the dud of the group. In fact, so much so, it's actually fallen from the largest market cap company in the U.S. to the number two behind Microsoft. So Microsoft just kind of slipped past Apple. And, this isn't surprising. When companies aren't growing anymore, why would we be paying the sort of multiple that Apple currently trades at, roughly, the high 20s, almost 30 times forward estimates. And so, as far as performance is concerned, the Magnificent Seven continue to be the dominant group, outperforming virtually everything last week. And, we expect that to continue because that's where the money is flowing to. And part of that is because there's so much passive money and there's such a large component of the indexes, whether it be the NASDAQ at almost 50%, or the S&P 500 at some 29%. So, we've got a very, very significant weighting and concentration in these stocks, and every passive dollar that goes into the indexes is going to continue to fund these stocks.
Jeff, can you talk to us about the performance comparison on the 8 MSCI factors?
Ken, just for fun, we decided to take a look at these different factors. They range everywhere from, say, high beta to low volatility, quality, high dividend yield, low market cap, momentum. These are just a few that value, of course. ESG is another one. And so, these different factors have a tendency to trend, right? And so when we look at them over longer periods of time, and we just decided to look at year-to-date factor performance this week, and it was interesting to us to see that quality was the only factor that has outperformed the S&P 500. So just being the curious minds that we are, we decided to open up the quality ETF and see what the holdings were. And lo and behold, 4 of the largest holdings are Magnificent Seven stocks, led by, of course, NVIDIA and Microsoft, which are about 11% of that index, and then Apple and Meta, another 10%. And then on top of that, we have Avago at around 3%, I believe, and one other tech stock that escapes me for the moment, another 3%. And so when we look at together, it all adds up to, say, 27, 28% concentration in these heavy tech stocks. Oh, I know what the other one was. It wasn't a tech stock. It was Lilly, which is the best performing healthcare stock, up dramatically because of their new drug, Ozempic. And so, at the end of the day, our thinking is that the quality factor really just kind of emulates the mega cap factor, which emulates the NASDAQ, which emulates the heavy concentration in the S&P. And so that's the explanation for it. Everything else is underperforming the S&P 500. But really importantly, momentum, which is the factor that has the highest efficacy to it of any factor that's ever tested, is negative year to date. And so momentum as a factor is not working, There is no trend in the broad market, just in these few stocks, this handful of stocks. And so, momentum's negative. High dividend yield has been negative, obviously, because, rates had moved against to new highs, to new extremes recently. That's backed off a little bit in recent weeks. But that has had a negative impact on high dividend yielding stocks as well. So, yeah, there you have it.
That's really interesting. Thank you for that breakdown, Jeff. Before we wrap on to the sector analysis, I just want to remind our viewers, obviously, if you're a subscriber, you can get access to Jeff's top picks. He always has five longs, five shorts, 10 tradable, actionable ideas. So I would again urge you to go check out the note in full. Jeff, so it looks like on the sector analysis, real estate had a pretty good week on across the board. What do you like going forwards? And I'd like to hear from your sector valuation analysis as well as your relative strength analysis.
Yeah, so let's go through all three of those. From a performance perspective, last week saw a huge bump in REITs and financials, right? They were up 7 and 8% respectively, I believe. And, I think there's something that can be gleaned from that piece of data. I mean, they were the worst performing sectors for all practical purposes, led by banks on the financial side, and then, real estate's in utter disarray, right? So to see some kind of a dead cat bounce was not unexpected. I mean, sentiment couldn't have been worse. They were as oversold as I'd seen these sectors since a year ago, October lows. And so, the big bounce off those lows of these two sectors was not unexpected. That being said, it doesn't change the fact that Bank of America's unrealized losses currently account for 60% of its market value, public equity market value. It doesn't change the fact that $500 billion worth of commercial real estate mortgages need to be refinanced in the next 12 months at significantly higher rates than they're currently at, with significantly lower collateral valuations than they're currently financed at, and likely to receive considerably lower leverage ratios in those loans. So, some of these properties are going to go either to work out, or the keys are going to be delivered back to the banks, okay? Because they're just not refinanceable under the current economics. Whoever owns them today has to go belly up on the trade. It's got to be resold to somebody else at a much, much lower level and then restructured, okay? That's what's going to happen. And that is not going to be good for these REITs, who are the biggest owners of these properties, right? So we think this is just a short-term blip. Okay, let's get on to what I like. That was your question. What do I like? Well, I can't not like tech, okay, because tech has the best relative strength right now, okay? It's benefiting from fund flows. It's not a valuation call. It's the highest valuation in the S&P 500 sectors, GIC sectors, right? So whether or not it's deserved remains to be seen. But I think the multiples are orders of magnitude above, the other sectors by and large. That being said, energy is the cheapest sector. And I think right now at this juncture in the market, if you're making investments, okay, you want to have a very, wide margin of safety, right? And paying the highest multiples for stocks in the S&P 500 isn't accomplishing that. Paying the lowest multiples is. So, energy from a valuation perspective looks extremely attractive, but it's an investment, not a trade right now. On the flip side, energy is rolling over from a momentum perspective and from a relative strength perspective. And that could take a while for it to cycle through. In fact, it's not just energy, but it's cyclicals in general. Energy, industrials, materials, financials, they're all losing relative strength and relative strength momentum. Meanwhile, healthcare, discretionary, REITs are all reasserting themselves on the downside, okay? Negative relative strength, negative momentum of relative strength, while staples and utilities seem to have stabilized. So we've got tech leading, we've got communications as part of that leading, and those are the areas that are probably going to lead in the fourth quarter on a relative strength basis. That doesn't necessarily mean that you're going to get great absolute returns from them. It just means that they're not going to go down as much as the others, because that's where people are huddling. That's where the strongest balance sheets are. And if we do get another push up in rates, then that could change that. But right now, as we see it, that's likely where the relative strength resides for the foreseeable future.
That's great, Jeff. Thank you so much for sharing your thoughts on that. As always, we really appreciate it. And I want to urge our viewers to check out Jeff's content on Substack at hugeinsights.substack.com. And until next time, thank you for watching. Good luck investing.